Thanks for joining us for our February sort of roundup summary and a little bit of an outlook into 2021. We've tried to keep it, given that it's a sort of intra-quarterly one, a little bit shorter, sharper and punchier, focusing a little bit more on some of the ideas, opportunities and potential companies that we think are out there that look interesting in the current market environment. So it's obviously not an easy market environment at the moment, so we'll sort of try and take you through asset class by asset class, talking about what we think makes sense to hold in our discretionary portfolios and some of the other ideas that are sort of spilling off the sides on that regards. So just in terms of usual bits as we're getting started, we're recording this, link is available afterwards, so we will be sending that round. A lot of the slides that are in the deck today will also be sent around, along with some additional information on some of the underlying performance of the models. And we will be stopping for questions at the end of sections if there are any. So please feel free to put them in the Q&A box, and then we can address them at the end of the sections, or if not, we'll come back at the end to try and hit them all in one go. And also, we are always very happy to hear suggestions, thoughts, ideas, ones, sort of companies that you're interested in hearing a little bit more about. So please feel free to get in contact with your relationship manager, reach out and let us know what you would be more interested in hearing about. So if we just move on to the sort of quick look at the performance section, just waiting for the slide deck to catch up, which seems to be having a couple of fun technical issues. There we go. So given the performance, we've had a bit of a tricky start to the year. If we're kind of looking month by month, you can see that the lower risk profiles, so conservative has been underperforming growth. The rationale for that specifically in dollars and sterling has been some of the movements in the yield curve that we have seen in the first couple of months of 2021. So seeing the yield curve pushing higher at the longer end, we had a bit of a holding of longer dated treasuries, and same in for UK gilts, which has kind of negatively kicked through in a performance aspect. So even though you've seen on the right hand side equity markets start the year positive, we have had quite substantial moves across the curve, to be honest, sort of 5, 10 and all the way up to 30-year in both the UK and the US, not so much in Europe. That's kind of the contrary to what we had happen almost not quite a year to the day, but in March 2020, when we had the opposite happening and we had a lot more protection in our dollar and sterling mandates than we did in euros. So we're seeing part of that outperformance from sort of March 2020 slowly start to revert back. And that's just for February. And if we skip across to year to date, we're seeing something similar, that our sort of positioning on the longer end of the curve has hurt us a little bit. Our focus at the moment, when we're looking at our actual asset allocation within the portfolios, we've been reducing down our exposure to longer dated treasuries, which has reduced our duration all the way down to about 6 for the dollar denominated mandates at a conservative level. We've also been increasing our allocation to alternatives. So in the difference between sort of February and comparing back to January, we increased 4% allocation to alternatives, picking up a real estate investment trust and also another commodities holding. I think if we skip forward about 2 slides, then we can kind of have a little bit of a comparison month on month between January and February. But the primary differences are, as you can see, there quite a substantial reduction in the allocation to fixed income, but at the same time, we've been pushing up some risk exposure in the portfolio. For a balanced mandate, we'd be expecting that the risk on, so sort of equity and alternatives combined together, would be sitting at about 45%. So at the moment, we're at sort of roughly 41%. So 90-95% risk on in that regards. A lot of our work has been focused on the satellite component of the equity part of the portfolio as well. I think this is what we're going to be talking a lot more about in the equity section of today's webinar, with some of our 2021 ideas, themes and opportunities. But just with sort of that little roundup, I think we're still slightly underweight risk, reasonably conservatively positioned, and looking for exposure to equities and alternatives to start clawing our way back up into positive territory on a year-to-date basis, which hopefully will be better the next time I'm sitting and briefing you guys. So that's it on the performance front. And unless there are any questions, I will pass across to James. James is going to start with a poll, so I will just launch that poll now. So question is, which of the following is expected to provide better returns over the next 3 years? An investment into crude or an investment into copper? James, I will pass across to you whilst people are voting, and then I'll share the results in a minute or two.
Fantastic. Thank you very much. I'm hesitant to go to the next slide, Simon. Apologies for my technical issues here, because I don't want to give away what my views are, but I suppose I have to. So there's a very strong cyclical recovery that's underpinning commodities generally. And I really would like to spend a few minutes today just focusing on the commodity space, because that's been quite extraordinary over the course of the past month. And I'm going to look in particular at crude and at copper. Now, crude supply is basically restrained, so it's voluntary cutbacks. Copper supply is constrained, it's involuntary, and I think that's the real key. And I think what that points to is an end to the long period of contango markets in copper, which is going to be extremely positive for both copper price, but more so for returns. So just to kind of set the backdrop, the strength that we have seen in both crude and copper prices is not a huge surprise. Both of them are extremely cyclical. So on the left-hand side, you can look at the percentage change year over year for Brent crude oil and also for copper, LME copper, and you can compare that to the global manufacturing PMI. And it's a strong relationship. When you've got an expanding economy, demand for crude and copper both pick up. So around May of last year, back if you recall, when the price of crude had sort of collapsed because of an excess, because people stopped traveling and there was just so much excess inventory that you moved into negative contango, we forecasted that crude would trade up to 65 sometime in the first part of 2021, and that's where we are. Purely a cyclical move, in my opinion, a cyclical move. And again, you can see the same thing if you look at both of these commodities relative to the USD, the dollar. It's not a difficult relationship to sort of understand. I mean, if crude is denominated in dollars, if copper is denominated in dollars, when the dollar weakens, then if nothing else changes, the price of crude, the price of copper is going to go up. That's why commodities are typically viewed as a store of real value when you are facing a depreciating currency, which is, I know, something that's on people's minds at the moment. But if you look at the supply and demand dynamics, they're completely different. So over the course of the past decade or so, crude supply has been leaping forward, often outpacing demand, and that's been a story, of U.S. shale production. So if you look at on the left-hand slide, if you look at the period from 2015 and 16, you can see that red splotch. So that red splotch means that supply was in excess of demand. So you had a surplus in the market. And that was the US. When it tapered off, that was because the Saudis had come in and absolutely obliterated the shale industry by flooding the market. Everybody closed down. And so it was a couple of years of that excess supply just kind of catching up with demand. That kind of story has played back and forth over the past decade and given us a lot of cyclical dynamics. But now what we have in 2020 is something that's sort of truly unprecedented. Demand collapsed and supply has been racing to catch down with demand. Now, what's interesting is that supply has done that. The cyclical recovery in the crude oil market has been matched with an aggressive move by the Saudis in particular, but also on the shale patch to cut back production. And that's a big part of the story in crude of late. Compare that with copper. So there has been a small copper surplus that emerged last year, but nothing like what you would expect given the collapse in global economic activity. That's because people stopped traveling, but they kept buying stuff. And what we have now is copper moving into what looks like a sustained backwardation for virtually the first time in almost a decade. For the past 10 years, copper has been in a surplus. And that means that copper has simply not attracted the kind of investment that you saw going into crude oil, where American shale was bouncing up every few years. So there's a real difference in the story on the supply side for both of these commodities, and that's going to have a real impact as we look forward and think about what happens on the demand side. Now, in the immediate term, in the very, very near future, it's all about inventories, and inventories are effectively just the rolling change or the accumulating change in a surplus or deficit. You can see that in 2020, inventories in crude oil surged globally to over 3.2 million barrels. Billion barrels, and that was a record high. I'm not showing it as a stocks to use ratio here because the collapse in demand makes that a bit difficult to interpret. That was a massive increase, and that's when we saw the super contango. That has been unwound. That excess has been brought back, and we are into the sort of normal range. But that's it. We've just brought inventories back into normal. If you compare that with copper, where I do look at inventory as a percentage of trend demand, copper is scraping the bottom. Copper inventories are basically down there as low as they were prior to the global financial crisis. So copper is a physically tight market, and crude oil is not a physically tight market. Copper is tight because of a decade of underinvestment in surplus markets. Crude oil is not loose because of the choices being made by producers like OPEC and by the people in the shale oil patch faced with these dramatic price movements. So how does this play out in terms of price and return? So just to remind everybody that the returns that you get from being long or short a commodity come from the backwardation. They come from the roll yield, much more than they come from the flat price. Now, both Brent and copper have moved into a backwardation lately. What's interesting is that for copper, it's kind of the first time in a decade. For crude, it's something that's been a more regular occurrence, or more frequent occurrence rather. The thing about crude is that when it goes into a surplus, when it goes into a contango, oftentimes you find that you have no place to store it, and so the value of that crude drops precipitously. It's called a supercontango. With copper, you can always find a place to store it. All you need is a warehouse and a dog and a lock, to guard it, and that helps to keep it bound. But it's really a contrast here between the two markets that I'm trying to sort of highlight. Now, the last time that we had copper in a really tight market was 2009, 2010. And that was when a decade of underinvestment in copper had led to an extremely tight market relative to the surge in Chinese and global demand. And you saw massive backwardations. And those backwardations are what drove copper returns into a really explosive place. That was back when you saw copper touching 10,000, for the first time in history. And it was pretty momentous, and it really shook the market. Now, let's think about what it felt 15, 20 years ago, back when copper was getting ready to have its first leg higher. So I remember this. I made an extremely bad forecast in 2003. I was quite convinced that copper had an upper ceiling at around $3,000 a ton. And I had mounds of reasons and research to support this view. But in large part, it was because I was looking backwards. And I was looking back over 15 and almost 20 years of history, the modern era since the mid-1980s, where copper always stalled out at around 3,000 because there was a supply response, because there was a demand response. Higher prices meant more production. Higher prices meant less consumption. The market rebalanced. So I had a model, I had a belief, I had a conviction, and I was absolutely wrong. And the market was absolutely wrong. Copper blew through 3,000. My next forecast was that copper would trade up to 10, and I was right about that. But trying to understand that copper was going from 3 to 10 was a bit of guesswork, because once you blew through that 3, you were in uncharted territory. So where are we now? And this is really what I want to kind of focus your attention on. So copper, if you look backwards from today, you see the recent peak at around $10,000 a ton. And so it is extremely rational for any analyst out there today to say, right, 10,000 is going to be the ceiling. And a lot of people are saying that copper is going to be pushing past 10,000, but only briefly, and then it's going to retrace. And they're saying that is because supply is going to expand as copper prices push through, and that demand is going to contract as copper prices push through. And that is the exact same thing that people were saying 15 years ago, and I think it's wrong. I think it's wrong for several reasons. We've talked about the cyclicality in these markets. That's very bullish for copper, very bullish for crude. But we've also talked about the supply dynamics of the past 10 years. Crude has built up an excess of supply. Copper has been underinvested. So there's a supply overhang in crude. There's a supply there's a lack of supply in copper. That's very, very bullish for copper. And then when you look at the demand side, BP, British Petroleum, has already called it as having the peak of crude oil consumption as having passed. And maybe that's a bit too aggressive, but the direction for crude demand over the next 20 years is pretty clear. People are not going to be driving internal combustion engines, and they're going to be driving electric vehicles. And that's just not good. The green revolution, or the green economy, is going to reduce demand for fossil fuels, just a fact. So that's bad for crude demand, but that's great for copper demand, because all of that electrification of infrastructure and all that electrification of transportation means more copper, which is really hard to take out. So as I look forward, there's some real strong demand drivers that are pushing copper forward, not just cyclical, but structural, thematic. And then there's a third one, which is even harder to sort of nail down, but maybe it's the most exciting. Blockchain. Blockchain requires an enormous amount of energy. And that energy is going to have to come from someplace. Now, most of it's going to come from stranded power, geothermal in Iceland and rivers in Siberia and solar farms in Saudi Arabia. But that takes copper. And a lot of it's probably not going to come from stranded power. A lot of it's probably going to come from siphoned power, in the rest of the planet, which is going to really be significant. Last I checked, the electricity consumption for cryptocurrencies was already past the annual consumption of Argentina and the UAE. And to be quite honest, that's probably stale data by now. So when you put these characteristics together, it seems very likely that copper is going to be breaking through 10,000. And once it breaks through 10,000, it's extremely difficult to know where it's going to stop. And that's really the message that I want to leave you with. The last time I saw an environment like this, it was the China story that people didn't fully understand, pushing the metal beyond 3,000 and creating scarcity pricing. Today, it's going to be the greening and the green economy story, and perhaps the blockchain story, again, meeting that underinvestment, pushing it to new levels, forcing scarcity pricing. How long is that going to last? Probably a few years, 5 to 10. That's how long it takes to start a new copper project. And what price level would I target? Who knows? That's the mistake I think a lot of people are making. So to go back to the poll results, I see that the people who are attending our conference are either extremely perceptive or agree with me. But I don't know if you can see these results, but it looks like the vast majority of you think that copper is going to be providing the better returns over the next 3 years, and I completely agree. Crude will have moments where it will spike. It will trade up and down, but it's going to be a very different kind of commodity market. And my colleagues on the equity side, Maxat and Mikhail, are going to be talking about a copper idea, that we've been working on of late and that we've already put into the portfolio that we can share with you. So with that, I'm going to hit pause and I'm going to pass it along to my colleagues in fixed income, unless there are any questions that anybody would like to raise at the moment. Somebody suggested that that I left one question. I left Bitcoin out of the poll. So what I'm going to do is I'm going to save the questions for the end, and I'm just going to move forward to my fixed income colleagues and hand it over to Adrian.
Thanks, James. I think that's sort of a very good starting point, talking about copper and how copper could be actually quite a good anti-inflationary asset for people's portfolios, especially with inflation becoming more and more of a concern for the fixed income market. And so far this year, we have to admit it's been a poor year for fixed income. Only high yield really has been hanging on to positive returns. So where does this leave us with fixed income? If we move on to our first slide, what we can see is what's been happening in the US yield curve this year. A lot of this movement has been the steepening that we've talked about in the last webinar as well. It's actually happening a lot faster than I expected, to be honest. We've seen that in February alone, it started attacking even the shorter end of the curve, especially the 5-year. And that's the part which has got me most concerned. And over the course of the month, as you can see, we've reduced our government bond exposure in our portfolios. You've seen that we sold down to 30 years. And in the slide, we saw that we have something like 4 or 5% of the portfolio in government bonds, which is very little. It's very little what I would call safety within a balanced portfolio. But the reason for this is just the outlook for fixed income on the government side is not great, as I started the year saying that any move in the yield curve will erase any kind of carry you have this year. And we've already seen that happening now. The question is, when will the Fed come back into it? So if we move on, we can see that this effect of the US concerns and the US solidifying its growth prospects, the inflation story, the fiscal surplus, has actually not just been localized to the US bond markets. The bond market's all relative. It's impacted every other market. We can see it happening in Germany, UK, Europe. Japan, which has a level of yield curve control, has seen their 10 years winding up to the top end of their range. We've seen Australia winding out significantly as well. And Australia actually started implementing more purchase programs on their 10 years to try to bring the yield curve back under control a little bit. But it's not just a dollar story. What we've seen is just happening in the local currency bond yields as well. So in Brazil, in Russia, yields have been increasing there as well. The one country which hasn't has been local currency Chinese bonds. So that's something we're trying to see how we can get exposure to, because we firmly believe that China could be, well, it's a growing economy. It looks like these yields aren't blowing out. That may be somewhere where we have to look for some potential returns. So why are we concerned about the actual moves in yields? If we move on to the next slide. The first thing I'd say is that it brings into question your investment choices. There's always been a factor that with the 10-year bonds actually yielding less than the dividend yield on equities, and we look at this by looking at the S&P 500, we've seen that for a long time, it's been much more beneficial to be invested in the equity markets. We still believe that's the case, especially with lower actual low bond yields still overall, which are increasing higher. But we can see now that the S&P yield is actually the same as the 10-year yield. So now the question's coming to people's minds, is it better to have the safety of the bond markets again, rather than just taking the equity exposure? This is going to be playing out, and as the yields go up more, this will become more of a factor against the actual equity market. And we're seeing that especially with the tech sector and more of the growth stories. The other factor that we've got to take into account is how the US economy can be affected by this. The first direct point I would say is we start looking at the housing market, the ability of people to refinance mortgages or get new mortgages. It's becoming more expensive. We've seen this now happening at the start of the year. It's been a massive spike. So any refinancing of house equity, any refinancing of mortgages, it's not really going to happen. It's not going to be an extra driver. So this is why we think could be a little bit of a pause in this bond yield story coming through soon. If we move on to our next slide, the real question for us is, what is the Fed going to do? And when is the Fed going to actually move and actually do something? Powell has been rather relaxed in this entire period, but they're not really willing to go through to implicit yield curve control just yet. But what we've seen is the markets really testing their resolve. They're starting to sort of pull forward the first rate hikes a lot earlier. They're now thinking there might be 3 by 2023. It's too much for us. The Fed is going to be very cautious. It's doing average inflation targeting. It wants to stay as loose for as long as possible in our view. So the first thing before yield curve control, which we think is going to come in, it's a question of when, is really to redo an operation which they did back in 2011, which was called Operation Twist. By this, what they did was actually start selling down or actually not buying the front end of the curve, which is the part they've been supporting very strongly, and actually buying more towards the longer end. Now, if we look at the chart on the left, we can see that in 2021, 2022, there's a lot of maturity coming in. So this is how front-loaded the Fed is at the moment. And actually, in the next 3 months, there's something like 400 billion of maturing bonds, which they can use to actually buy the mid part of the curve. Is where we suspect they will start targeting first, to try to pull the yield curve down a bit more, especially the sort of between the 7 to 15-year area. That's what we think they're going to target. So our feeling is that they're going to be moving to that area, and that's why we're still holding some 10-year bonds in our portfolio for safety, really. What little holdings we're having at the moment. And once we do see signs that the Fed is moving into more of a yield curve control, we're going to expect more flattening of the curve, then that's when we're going to be looking to extend our duration once more. And at this point, if we move on to the next slide, I believe that we're now going to be talking about how the Treasury moves have been impacting the credit market. And to do this, I'll hand you over to my colleague, Jeff.
Brilliant. Thanks a lot, Adrian. So we spoke last month in our webinar about the correlation between treasuries and investment grade rated corporate bonds. And if we revisit that, on the chart to the left on that dark blue line, you can see that there's clearly very strong positive correlation between IG bonds and US treasuries, and that's remained intact with the exceptions of periods of where we saw market disorder. They were in the downturns of 2001, 2008 and 9, and also last year where central bank intervention came in to calm down the markets. But for bonds rated BB and below, so that's junk bonds, they trade with a very different relationship to treasuries. Notably, the correlation has been negative in the years where the stock market took a downturn. So again, that's 2001, 2008, again in the commodity rout of 2015. Then we had a market sell-off in the final quarter of 2018. So it has much closer links to the equity market. And some of the explanations for that, apart from the hybrid nature of high yield bonds, it's also because it has much shorter average duration of just 4 years, which is half the average duration of 8 years in the investment grade bond market. So it's a lot less sensitive to changes in interest rates. And if we recall through simple bond math, for any similar change in yield, it equates to a larger price move in longer dated bonds. So we expect more price volatility at the longer end of the Treasury curve for any move in the yield curve. So just to give some examples, on a year-to-date basis, the 5-year Treasury has moved from about 30 to 80 basis points. So it's down 2 cents on the dollar. Now, the 10-year Treasury has moved from about 90 basis points to 1.5%, and it's down 6 cents on the dollar. And the 30-year Treasury has moved from 1.6% to 2.3%, and it's down 14 cents on the dollar. So you get a sense of the magnitude of similar changes in the yield, but a much larger price impact at the longer end of the curve. So our strategy, which Adrian had just spoken to, of maintaining an underweight allocation to duration and staying in the shorter end of the curve, it served us very well from the perspective of capital preservation. And the chart on the right probably tells that story the best. High yield returns have taken less of a beating from the Treasury sell-off. If we just move on to the next slide. So how are we actually positioned and practiced for the volatility in Treasuries and also for a world beyond COVID? So the two examples of corporate bonds I want to share with you. One is a COVID recovery trade and the other is a COVID resilient company. Now, first up, in our COVID recovery basket, we've got a household name Dell, and it's probably best known for its consumer laptops, but the company actually generates the lion's share of its profits from selling desktop PCs, servers, storage, and networking solutions to commercial customers. Now, enterprise IT spending took a bit of a hit last year, and that's part of a lot of company efforts to reduce IT costs in the face of a reduced workforce amidst job cuts. Makes a lot of sense. But we've already begun to see a rebound in IT spending, setting up a positive near-term outlook for Dell. But we've also got medium-term considerations to think about. And that's in the face of, well, the future of IT work solutions. Now, we expect a tailwind to emerge from COVID, and that's because we think that total investment in PCs will increase as we see a higher number of PCs per person to accommodate this flexibility so that we can work from home, learn from home, play from home, and have that duality of being able to work from the home and the office. And it's just become more important than ever to have a reliable workstation at home as well as at the office. And an idiosyncratic and specific individual to Dell, it's also a rising star candidate of choice, and that's because it has very concrete and clear debt reduction aims. It's still a core priority for the company, even after the company paid down $5 billion of debt last year. Last week, in its earnings results, the management team came out and said, look, we're going to pay down another $5 billion of debt this year. So we think that really sets up Dell for an upgrade to investment grade status, which will drive bond prices higher. And then second, our portfolio holding is Berry Global. It's a stable, no thrills packaging company. And it is, however, highly indebted. And when investing in highly indebted companies, one of the most important factors that I like to look for is it's a business model with very stable earnings from year to year and very predictable cash flows to ensure that the company can service the debt. And Berry Global has both of those attributes through its exposure to stable, developed countries and consumer end markets. But you can also see from that probably not very exciting portfolio of products that has in the top left of that chart. Berry, it makes more than just Philadelphia spread packaging. I can see that, but they also make Perel's hand sanitizer dispensers. You've got medical PPE, inhaler casing, disinfectant bottles, disinfectant sprays, and we really think that improved hygiene standards through COVID are a new normal, and the demand will remain well supported going forward. So 2 ideas there, but in terms of the bond positioning, look, we're given what I've said on and commented about the previous slide, we're avoiding the price action. So the top right corner of that chart on the right, we're avoiding that, but instead we're positioning ourselves in the belly of the curve. Despite the much lower coupon, we're seeking to minimize our downside from any further treasury yield curve volatility. But we do appreciate this return profile with yields of around 2%. It doesn't fit all of our clients' return objectives, which brings me nicely onto the equities section of the webinar, where we can seek out much higher returning investments.
Thank you. Good afternoon, everyone. Today we're gonna speak about our framework, how we source our investment themes, and also we'll touch tech resources, which we think an attractively valued way of getting exposure to copper. We are positive on copper, as my colleagues already mentioned. And finally, we will speak about robotics and automation as a standalone investment theme. Let's start with our thematic mappings. So during previous webinars, we been talking about online live and video games, and these two themes still got their underlying long-term drivers, but the pandemic created such a strong tailwinds that actually this business has been growing faster than long-term trends, and now we expect some kind of moderation. And here we are looking at themes which are supposed to capture change of human behavior. So this theme is supposed to capture way how we are treating our planet, how we are working, and how our workplaces are gonna look like in the future. So once we arrived to these broad themes, we're trying to find kind of bottlenecks. So trying to find what prevent these themes to get adopted broader and faster. So, and this is the most interesting industries to get exposure to. So we are looking at single stocks. So it is ordinary, either incumbent, which got superior technology and trying to kind of reinvent themselves. So ordinary, this is kind of a value play with a trigger. Or we're looking at innovative, so we're looking at young disruptor. So ordinary young disruptor, it's quite expensive, and this is a no valuation support. So as to latest example, so we've been looking at electric vehicle theme, investment theme, and we decided to invest in stocks of Volkswagen, which is the incumbent with superior technology. Although it's still not as good as Tesla got, but in terms of valuation, it was much more reasonably priced. Speaking about future themes, so as my colleagues already mentioned that we are positive on copper, and also we're thinking that it falls under several investment themes. So this is the electric vehicles, this is robotics and automation, and even blockchain. And speaking about one way of getting exposure to the theme, to copper, we're thinking about stocks of tech resources. So tech resources is a Canadian diversified miner. And at the moment, it is focused on steel making coal, zinc, and copper. And not surprisingly that it trades in line with average valuation multiples for diversified miners. While we can see that actually copper producers, they got much higher multiples. But actually we're thinking that in coming years, tech resources will be getting more and more closer to copper producers. So it developing Quebrada Blanca Chilean project, which is the copper project, and this project should double copper production in 2023. So once it will happen, market will reconsider tech resources not as diversified miner, but rather copper miner. And in this way, we can expect that the business will be growing not only via copper prices growth, not via only production growth, but also be rewarded by high valuation multiple. And you can see that at the moment, there is at least a 40% discount of diversified producers to copper producers. And on this, let me ask Maksat join myself and speak in more detail about robotics and automation.
Thank you, Misha. Good afternoon, everyone. So I would like to talk you through our thinking behind robotics and automation, which is actually a simple idea in its nature, and the main driver behind it has been the divergence in labor and industrial robot costs. So if you look, for example, at the US, since 1990, labor costs over there have risen approximately by 2 times, whereas prices for industrial robots have fallen by half over the same period of time. This dynamic is representative not only of the United States, it is actually the case globally, and even in emerging markets. So for example, if we look at China, which has been the main destination for manufacturing outsourcing, labor costs there have risen even higher by roughly 2.5 times since the start of the 90s. And so these developments have fueled the growth in global shipment of industrial robots, which have expanded by roughly 6 times since the beginning of the century. And speaking about specific companies that provide exposure to the theme, we have compiled a watch list. And first, I would like to talk you through the main criteria that we look at when searching for companies. And if we move on to the next slide, so we considering that robotics and automation is still very much a growth story. And as Misha pointed out previously, a lot of new companies or young disruptors are usually traded at very expensive multiples. So what we are looking at is a combination of attractive revenue growth, but also earnings growth, and the companies that are trading at reasonable multiples. So in short, we're looking for profitable growth at reasonable valuation. And so considering these factors, I would like to focus your attention on 2 companies, IPG Photonics and Trimble. So Trimble is a US based company. It provides navigation solutions in GPS positioning and operates across multiple end markets. So in infrastructure, in geospatial segment, in renewables and precision agriculture. It is also diversified by geographies, but its main market is in North America. And the second company, IPG Photonics, they produce industrial lasers, and the company is the global leader in industrial lasers. It manufactures lasers with a combination of high quality and full integration, full vertical integration. Now we actually speak about robotics and automation in more detail from a deglobalization point of view in our quarterly, in the thematic section of our quarterly, which I believe should be published in the coming days. But yeah, so this is in short idea, the thinking, our thinking behind robotics and automation. And on this, I would like to pass to Simon.
Perfect. Thanks, Max. We've had quite a few questions coming in, a little bit of a focus on electric vehicles and some of the other stocks in that space. And then another one as well that I'll invite James to give his 2 pennies worth afterwards. Just on the EV space, and it's quite an interesting topic and one that we've spent a lot of time discussing internally. and this is kind of focused on a couple of different aspects here. One is the technology of the actual batteries themselves, and what kind of distance can you get out of a single charge. Secondly is then kind of looking at, well, how long does it take to charge the car up in the first place? And then that kind of brought us on to a lot of the conversations that we had partly last month, but on an ongoing basis internally, is, where's the national, international infrastructure from a charging perspective, and how much further can battery technology develop in order to provide cars with much larger range, much faster charging time, and do it in a way that is less damaging to the environment from a metals mining perspective. I know that there are lots of different battery technologies that are being developed concurrently, but for the time being, we're in a situation where, irrespective of the manufacturer, the batteries are going to be using metals. We took that as, and why I think Tech Resources looks quite interesting, because you'd rather back, from my perspective, the materials and underlying components that are sitting within the electric vehicles, rather than looking specifically at the manufacturers themselves. And we were having a big conversation about, do we look at some of the Chinese EV makers? Do we look over at Tesla, which we've always struggled on a sort of justification of pricing and valuation perspective? Or as Mikhail was highlighting, looking at VW as this sort of incumbent, but also disruptor at the same time. And looking at it from the perspective of, it has the manufacturing lines, it has the distribution facilities through the shops and sales and forecourts. So I think from that side, the other side of electric vehicles, which has been interesting from a discussion point, is are they entirely green or not? And I think the answer to that question is, it depends where in the world you are. You have countries like Iceland, where the entirety of their or a large part of their energy and electricity generation is geothermal, where the cost of charging up the batteries is going to be much more beneficial for the environment than a country such as China, for example, where they're still much more reliant on coal burning. So even the what is the environmental cost of charging the batteries is an open-ended question that's impossible to answer. So I think from our side, we like the concept of electric vehicles. The battery technology is still very much in development and is only going to improve. Governments have been subsidizing historically people to make the move into electric vehicles, and we think that that's a momentum that isn't going to cease in the near term. So from our side, when we're looking at how to get exposure and what to buy, Volkswagen from a EV producer side and Tech Resources from a material side. James, I was going to ask you to jump in just in a question on, in a post-COVID world, will it pay to be more value-driven or growth-driven?
Sure thing, Simon. There's something going on with my camera. I'm not sure. So that's a great question, and I'm glad it was asked. So this is a question that we have looked at in quite a lot of detail over the course of the past 6 months, and we have a strong conviction view. We think that value over the course of the coming several years in this post-COVID environment is going to be where the returns are generated relative to growth. And late last year in the fourth quarter, we put that into place. We actually initiated a value tilt in our equity portfolios through ETFs, and then earlier this year, when the global markets had a bit of dip in January, we actually added to that tilt. So why is that? So typically, when you're coming out of the early stages of a downturn, a recession, and a stock market correction, that's when value tends to have a better time of it. Secondly, value has had a absolutely horrendous time over the course of the past 10 years. It's really been shocking, the extent to which value names have underperformed growth. But there's a reason for that, and that reason comes back to interest rates. The last 10 years have been the best part of what has been a 40-year bond bull market, and the last 10 years have been extraordinary. Well, we've reached pretty close to zero, the zero bound, the lower end for where bond yields can go. We can't take another 15 percentage points off of Treasury. We just can't do it. So what that means is that one of the really big engines supporting the growth story yields, discounting future earnings to the present at ever declining discount factors or yield or rates, just makes those earnings ever more attractive. That's gone away for growth, so that takes away a lot of that relative attractiveness, and that's a big part of why we like value. So yes, value over growth, it's our view, and it's one that we've already been putting into action over the course of the past 6 months.
Perfect. Thank you very much. There aren't any other questions that have come in, so I think all it remains for us to say is thank you very much for joining us for the webinar. We've got another couple of videos that we're going to be trying to record and distribute out over the next month or so, trying to pull together one really interesting conversation on sustainability of food, which kind of fits quite nicely into some of the ESG investment opportunities that we've been looking at. So keep your eyes peeled for something coming around on that front. Otherwise, it's probably the first time for a long time that we've actually finished one of these, and it still seems to be light outside. So I hope that everybody has a good afternoon and a productive month of March. Thank you very much, everybody.